Welcome! CPA Planet lessons help you get more points on your CPA exam. These lessons provide clear explanations from the student's perspective, visual learning, and we even try to make it interesting and entertaining. Enjoy the lessons and pass the CPA exam.
So partners' gains or losses we were going to talk about. So they can have gain or loss on the contribution of property, which, as I mentioned, isn't recognized, but it is realized and you have to keep track of it. There is gain or loss on services rendered to the partnership, and you can have passive losses as well. So gain or loss on services rendered is the exception to the non-recognition rule. As I mentioned, you do have to recognize that as ordinary income to the partner that renders the services. So for passive losses, the partnership loss will be a passive loss to a limited partner. A partnership loss may be a passive loss to a general partner, depending on whether the partner meets the material participation test. Without specific information, such as the number of hours or the number of participation for the partner, partnerships engaging in rental activities are most likely passive. So let's go over an example of this. Bertie receives a 20% interest in the partnership of his uncle's sweet sugar stocking stuffer conglomerate in exchange for services rendered. On the day he was admitted to the partnership, the assets have a basis of $1 million and a fair market value of $8 million. So he'll have to recognize $1.6 million, which is 20% of the fair market value of the $8 million. And he has to recognize that income because he rendered services instead of contributing property. So next we're going to discuss some built-in gains or losses. So this refers to property that has a fair market value that's different than the basis at the time of its contribution to the partnership. In other words, a built-in gain means the fair market value is larger than the basis, and a built-in loss means the fair market value is less than its adjusted basis. Built-in gains and losses are allocated back to the original contributing partner when the property is sold, and it's not allocated evenly to the partners. The built-in gain or loss is allocated to the contributing partner up to the amount of the gain or loss realized on the sale. But there are time limits for this. So the limit is the built-in gain property must be distributed to the partners within 7 years. And the characteristics of gains or losses as capital as opposed to ordinary is 5 years. Deferred gain or loss, so that no deferral is available for the contributions to a partnership in exchange for property. A deferral is only available for exchanges of property for a partnership interest. So let's talk about how this built-in loss really works. First we'll talk about when contributed property is appreciated, which means there's a built-in loss. So when a partner contributes property which has a fair market value higher or lower than the adjusted basis, the built-in gain or loss with respect to the contributed property when sold must be allocated only to the contributing partner. So exceptions for the non-recognition is that services contributed for the partnership interest create income in the amount of value of the partnership interest, which also becomes the adjusted basis of the partnership interest. There's no deferral for contributions that are essentially disguised sales or attempts to diversify stock holdings. Appreciated stock contributed to the partnership does not get deferred gain. For example, Genghis Khan contributes stock in exchange for a 10% interest. The stock has a fair market value of $10,000 and a basis of $1,000. If he withdraws $10,000 in cash 2 weeks later, this would actually be viewed as a sale, and the gain of $9,000 would have to be recognized by Genghis. So, we're going to go through a detailed example of gains and losses on property subject to excess liability. So when property is contributed, which is subject to a liability, such as a mortgage, where there's a decrease in the partner's individual liability, and that exceeds its partnership basis, the excess amount is treated like taxable boot and is gain to the partner. So we have mentioned this before, but let's just go over an example. In this example, we're going to have Superman and Batman form a partnership, and they each contributed $100,000. So the fair market value of both of those were $100,000, but the basis differed. Superman had $45,000 and Batman had $8,000. So the partners share profits and losses equally, so 50% each, and during 2015, each partner withdrew $4,000. So next you're going to subtract the $4,000 from their basis and then recalculate the basis at the end of the year before the pass-through. So the partners have a basis of $41,000 and $4,000 respectively. Then you have to factor in that the partnership has an operating loss of $12,000. So then you allocate the $6,000 to the partners evenly, but unfortunately you can't because Batman doesn't have enough basis to cover this. So you would allocate half of that, the $6,000, to Superman because he can cover that, and only allocate $4,000 to Batman because that's his remaining basis. So then when you recalculate the basis at the end of the tax year, Superman would still have $35,000 in basis and Batman would have $0. And then the excess loss of $2,000, the $4,000 and $6,000 difference, is carried forward until Batman is able to use it, until his basis recovers. So if a decrease in a partner's individual liability exceeds his partnership basis due to property being contributed, which is subject to a liability, the excess amount is treated like taxable boot. So if he receives more liability assumption than his basis, then he's going to have to recognize that as taxable gain when he contributes the property. And there's some examples of that you should definitely take a look at in the notes. Next, we're going to go over sale of contributed capital assets with built-in capital losses. So these generate capital losses to contributing partners only for 5 years after the contribution. But for built-in capital losses, the amount of loss that can be reclassified as capital is limited to the built-in loss at the time the asset was contributed. So we're going to go over an example of this. So Partner Tuppy contributes an ice skating rink to a partnership, which will be used by the partnership as inventory. At the date of contribution, the fair market value is $10,000 and the basis is $15,000. So the built-in loss is $5,000 when it's contributed. When the skating rink is sold, the first $5,000 of recognized loss will be allocated solely to Tuppy because it's a built-in loss. If the partnership sells the assets 3 years later for $5,000, the recognized loss is $7,000, and the first $5,000 is allocated to Tuppy. The remaining $2,000 of loss is allocated to Tuppy and the other partners based on their loss-sharing ratios. The $5,000 loss allocated to Tuppy is a capital loss since this was sold within 5 years, and the remaining $2,000 loss will be characterized based on how the partnership used the asset. So it'll be a carryover. If it's inventory, it's an ordinary loss, or if it's capital, it's a capital loss, but the remaining loss is characterized depending on how the partnership used it. Note that only the built-in loss is recharacterized as capital loss.